Let's talk money.
Welcome back. You're watching Let's Talk Money, and this week we're in conversation with Mihir Vora, and we're discussing how to go about selecting mutual funds. This is a lot harder than perhaps you would consider at first glance. It's not about just getting the best tip about the best fund. You want to be more involved with the whole process, so awareness and sort of getting down into the details. That's what it is all about. Now, Mihir, before we start talking about learning more about the market and cycles, etc., another concept, like when we talk about stocks, there are certain ratios. You need to know the price to equity, a price to earnings ratio, or the ROE, etc. When we are discussing mutual funds, apart from price performance, are there any other parameters or ratios that one needs to keep in mind?
Absolutely. So as we just discussed, the first thing to understand is that returns should not be looked at on a standalone basis.
Sure.
You need to adjust for risk. And there are many ratios available in the market, and again, websites have it, etc. But they look very complicated. But actually, they are not very complicated.
Okay.
Essentially, what ratios do is look at the returns. For example, in the Sharpe ratio, the numerator is the excess return of the mutual fund or the portfolio compared to the risk-free rate, which is typically the government bond yield.
Okay.
So risk-free rate, that's the excess return. And then the denominator is the volatility of that excess return.
Okay.
So the excess return, is it consistent or very volatile?
Okay.
So if the excess return of the portfolio over the risk-free rate is very high, then it drags down the Sharpe ratio.
Got it. So because you're getting the higher return with so much volatility.
With so much volatility,
that
exactly.
it could really be, it could make your heartbeat fluctuate.
Absolutely. Similarly, in the information ratio.
So just to complete the Sharpe ratio point, that means the higher the Sharpe ratio,
the better.
The better the fund, right?
Absolutely.
Simple.
Because either your returns are much better or your volatility is much lower.
Absolutely.
So you are basically, in all these cases, you are adjusting for risk.
Sure.
Risk always comes in the denominator and the excess return of the returns come in the numerator.
Got it.
Similarly, in the information ratio, instead of the risk-free rate, you calculate the outperformance or underperformance of the portfolio versus the benchmark. And then the numerator and the denominator is the volatility or variability of the excess return versus the benchmark.
Okay.
So in the first case, it was the risk-free rate.
Yeah.
In the second case, you are comparing versus the benchmark. In both the cases, you are calculating excess returns in the numerator
versus
and the volatility in the denominator.
Got it. Got it. So these are some more tools to, understand if a fund is giving you better returns. Is it worth it? I mean, is it coming with less volatility? Is it still consistent or not?
Correct. And then there's one more layer to it.
Okay.
When you're talking about the benchmark, you also must understand what the benchmark is. So benchmark itself may be more volatile or less volatile.
Sure.
So if it's a FMCG fund, the benchmark itself will be less volatile.
It will be the Nifty or the BSE sector index, the FMCG index.
Exactly.
Yeah.
Or if it's say a pharmaceutical, if it's a infrastructure fund or a manufacturing or capital goods fund, the benchmark itself will be more volatile.
Sure.
So then your excess returns will be versus a more volatile or a less volatile benchmark.
Sure. So some factors to keep in mind. Also, while we are discussing, concepts around this, I want you to demystify the concept of NAV itself, because there are lots of myths around it, right? Is a high NAV fund good, a low NAV fund good? So this is myth buster time then on NAV.
Absolutely. So NAV is nothing but, the assets of the fund divided by the units, number of units that have been issued. So it doesn't really matter because every day you're issuing more units or less units depending on redemptions, inflow, outflow. So the denominator, of course, is the number of units that the shareholders own, and the portfolio is the is the numerator. So the denominator is the number of units. So it doesn't matter whether you start at 10 rupees or 100 rupees.
Correct.
For example, our FlexiCap fund that we launched a couple of months ago is up by 10% on a 10 rupee NAV, because the markets are also plus minus 10% in that same time frame. At the same time, I'm sure there are funds which had a 100 rupee NAV at that point in time. So my 10 is up to 11, and the 100 rupee NAV fund would be up to 110. So ultimately the returns are similar,
exactly,
but on a different base.
It's like the same concept.
High NAV or low NAV in absolute terms doesn't matter. It doesn't matter.
It's like the same concept. The price of the stock per se doesn't matter whether a 100 rupee stock goes to 120 or whether a 200 rupee stock, rises by the same percentage. Exactly. So got that. So important concepts. Hope our viewers are listening in carefully. Now, Mihir, to come to the aspect of knowing more about the market as we want to evolve as investors. Cycles, styles, and it's getting more and more complex, right? Because you have this momentum style and the quality style and low volatility, etc., etc. Then you have different sectors. You have funds coming on infrastructure, like you said, on FMCG, on pharma. So it's getting really complicated for us investors out here. How do we navigate this?
No, absolutely. There are two things that we already discussed. In the first part, which was defining your goals, the first thing was know yourself, right? Second was know the fund house or the fund manager, right? And in this, you actually need to know the characteristics of the underlying asset classes.
Sure, sure.
So we've seen that, no style or sector performs consistently over each period of time.
Sure,
so if you even look at a longer term of 1 year kind of returns, you've seen, for example, from 2012-13 to say 2020, private banks did very well.
Yeah.
Then low volatility stocks, high quality stocks did very well. But for the last 4-5 years, we actually see momentum and high beta stocks do very
Absolutely.
well. Metals have certainly done well. For almost 8 years, IT was a big underperformer, right? From 2012-13 to almost 18-19-20. But in the last 3 years, IT did very well. So no one value, momentum, quality, low volatility. These are all different styles and strategies which can work at different points in time. So either you as an investor take up the onus on yourself to decide, try to figure out which styles you're going to buy, or you leave it to the fund manager.
Sure.
So as I said, by default, you should go for a diversified fund. That should always be, whether it's a large cap fund or a flexi cap fund or a multi cap fund, that has to be the core holding in your portfolio. And then the extra kicker based on your financial advisor or knowledge, you can play. That's where the thematic funds come in. Suppose you are really bullish on the manufacturing theme for the next 5 years, you might want to put some part of your portfolio, but not a big chunk of your portfolio in that theme. But then that portion you will have to actively monitor and manage. It can't be a buy and hold.
So, I actually have a quick question on thematics, and maybe we can quickly take this up. Last few minutes left on the show. This is from Shabeen. She is a viewer, and she's, asking, how can I select a sectoral mutual fund if I want to weave it in my long-term investment portfolio? And can I actually look forward to more appreciation if I add thematics? I think it's a very relevant question.
Absolutely.
So what should the approach be?
So, see, that's what I'm saying. When you're choosing a diversified fund, flexi cap or large cap or a multi-cap fund, the decision to go for a particular theme or a sector lies with the fund manager. But when you're selecting a thematic fund, the decision to go in that theme or that sector is yours. So if you want to choose a sector fund, you have to then yourself do a good analysis of the sector, take a view on that sector, and then actively monitor it. You can't just buy and hold it, because the decision to go for that theme or that sector is yours.
Okay, Mihir, it's been a great classroom, lots of concepts, but we now want to recap, and also maybe the stuff to do and also the stuff not to do, the mistakes to avoid. So in a nutshell, if you could sum it up for us.
See, as I said, you need to have a plan, follow up on the plan, and monitor the plan on a reevaluate on a periodic basis, and look and just focus on the basics. Don't over concentrate in one fund or one stock or one fund house, diversified across a few funds, but then don't over diversify also. So take a few funds, monitor them closely, and once a year just see whether things are going as planned and rebalance it. So that's one. Second is, do not ignore other asset classes. For example, debt fund is a significant category that can also add stability and a regular income to your portfolio. Sometimes people mistake mutual funds as only equity funds. But debt fund is also an asset class.
That way, just stock market.
So debt fund is another asset class that one should look at. So those are the basics one should take care of while building the portfolio.
So before I end, because Mihir is the big boss at Trust Mutual Fund, you tell us personally, what funds do you like to be in, and for your personal investing style, what kind of funds do you have your money in?
So my big money is of course in my own fund, and we only have one fund at this point in time, which is a flexi cap fund, and a little bit in the other fund, because anyway skin in the game demands that we put money into the other income funds also. So right now most of my mutual fund investments are in the flexi cap category, of course.
Okay, all right, Mihir, great conversation. Thank you so much for joining in and busting some of those myths and also giving us some very important concepts. Investing in mutual funds, really 101. Thank you so much.
Thank you for having me. Always a pleasure.
All right, with that, we're out of time. But remember, this is your show. Keep sending us your feedback, comments, queries, other issues you want us to discuss, and we'll keep getting them to you. Thank you very much for watching. See you again next week.
Let's Talk Money.